Welcome to The Real Recipe, the podcast that brings you the perfect blend of real estate trends and topics, where we serve up fresh insights and sizzling strategies. So let's get cooking. All right, so welcome back for another episode of The Real Recipe. Today we're going to talk about a really hot topic today. Certainly something that has gotten a lot of traction out in the media, a lot of misinformation, and so hopefully we can dive in and cure a lot of that. So we're going to talk about the changes that took place on May 1st to loan pricing, loan level price adjustments, something that we call LLPAs in the mortgage business. And we're going to dig into that topic real quick because the amount of misinformation that is out there today is absolutely insane. The amount of phone calls I've gotten on it.
I was on Instagram and I saw someone post.
Oh yeah. It is so wild that this is actually out there. And we'll talk about some of those, so some of the topics and some of the things that I've seen that have been put out there, which are just completely insane.
Yeah.
But let me start by kind of reading through. There was a good article that came out the other day. I'm going to read through it real quick, and then at the end we can kind of talk about what the reality of it really is for the consumer. So starting May 1st, the Federal Housing Finance Agency's mortgage pricing adjustments went into effect, whereby they're increasing fees for borrowers with high credit scores while simultaneously reducing costs for borrowers with subpar credit. It's sort of an upside down policy and definitely for me recalls memories back to the 2005, 2006, 2007, 2008 mortgage crisis that we had. And certainly one has to wonder if anyone in this current administration is recalling any of these events that occurred about a decade ago.
Right.
So it has really been an interesting topic that's out there, and certainly one where there has been a ton of misinformation. So what's the reason for changing these fees, or why are we changing these fees? So the plan is basically to make housing more affordable for everyone, right? We've certainly seen this story before, but these upfront fees, which are the costs that are associated with certain aspects of your mortgage, again, LLPAs or loan level price adjustments that we make, and that's how we price a mortgage when we go to quote a rate to a consumer. These upfront fees are for loans specifically that are backed by Fannie Mae and Freddie Mac, okay? And again, they'll be adjusted based on a borrower's credit score, amongst other things too, loan to value, debt to income ratio. There's other attributes that play a role in that. But specifically the one that we're talking about today is relative to credit scores. So borrowers with higher credit, the news media is putting it out there. So borrowers with high credit scores will pay more in fees, while those with lower credit scores will pay less.
Those have been the headlines.
Yes,
everywhere you go.
A lot of them, and this is where I have a huge problem, with the way that the media has been reporting this topic. It's just so all over the place, and I think a lot of it has to do with clickbait and everyone's trying to portray it as some sort of subsidy, for low credit score borrowers.
Absolutely.
But the reality is that's just not the case. And so here's kind of the crux of the issue. So borrowers with a credit score of 720 to 759, which would be considered A credit, and they do maybe a 15 or 20% down payment. Mm-hmm. That borrower will have a slight increase in the cost of their mortgage by 75 basis points, or 0.75%. Inversely, under these new adjustments, riskier borrowers, borrowers with a credit score of 639 and below, and who put down only 5% of the value of their new home purchase, will only have to pay 1.75%. And compared to what it was previously, which was 3.75%, is a 2% decrease in their cost.
So real quick, for people who have no idea what you're talking about.
Yeah.
When you say 75 basis points, or you say 0.75% and 3.75%, you're throwing numbers around that.
Yeah, so that
people who are maybe listening to this are listening to this because they've received misinformation and they're just like, well, I have great credit now. I'm paying a tax, and I'm subsidizing people with low credit.
Yeah. Yep.
So what does that mean? If I have credit between 720 and 759, and I am in that 15 to 20% down payment range, and now you're telling me the LLPA is adjusting by 75 basis points, what does that mean to me as someone with good credit?
Correct. So let me be clear here, right? These are pricing adjustments that we as the lender add or subtract when we're pricing out a mortgage for you. So, it's very common to see a no point mortgage or a mortgage with no origination fee.
Right. Yeah.
And embedded in the price of that mortgage is all of these different adjustments. We just basically determine, like, okay, I'm going to give you this rate. It's going to have no cost to you as the consumer, but embedded within the cost of that loan,
It's there. Yeah.
it is these particular costs. So these costs are not a direct increase or decrease for interest rate that you as the consumer would see. It's just something that we do on the back end or behind the scenes to adjust your interest rate up or down to absorb this particular cost or whatever the cost is for your particular mortgage. So it's not a direct increase or decrease to a mortgage.
No, it's another factor that you take into account when you're calculating.
And the consumer never sees this.
Right,
It's
but to answer the question,
yeah,
75 basis points, how is that?
75 basis points or 0.75% is or would be determined based on the loan amount that we would be using. Okay?
So does that mean my interest rate, let's just say, could have been 3, but now it might be 3.75%? Like, because that's what I'm trying to get at. For someone who has no idea what you're talking about, even right now explaining it, dumb it down so simply.
Yeah, like I literally, this, on anticipation of this, because this is such an interesting topic, I literally wrote out all kinds of different scenarios.
Yeah, right.
So that we could talk, like, what does it really mean for a borrower? Like, what does this really mean interest rate wise for a consumer? And I think that's where the biggest misconception is right now, and the biggest. Again, I think a lot of the media is just putting it out there or spinning it in a certain way so they can get clicks out of it.
Yeah, I agree.
Because it's just
what
not,
you just said. Every single headline that are people jumping on social media, it doesn't break that down in any sense at all.
No. It's just and on the surface, it does reek of some type of socialist policy or some kind of subsidy for a borrower.
And those are the text messages I get. You're in real estate. Why am I getting taxed to help someone with low credit?
Right.
And I said, well,
there's
get off social media, because please don't tell me you're relying on Instagram for your educational news source or whatever it might be, right? And whatever else. But those are the texts that I think a lot of us are getting. Like, so you're telling me May 1st now if I want to refi?
So this all started 2 Fridays ago?
Basically, a couple
2
weeks
Fridays ago,
Right.
when I was down in Tampa. I mean, my phone's blown up. I'm like, what is going on? What in the world is happening right now? And why am I?
Well, I think I texted you. I said to you, I was like, can you go on social media and clarify this for people?
Oh my gosh, it was wild. Just phone call after phone call after phone call. Oh my God, I'm paying extra. Is my rate going to be higher now? It was pretty wild.
Yeah.
So according to the Federal Housing Finance Authority or agency, these new adjustments are designed to redistribute the mortgage costs to reduce interest rates paid by riskier borrowers, whereby closing that gap. Because before a lower credit score borrower, and you'll see when we talk about interest rates, I mean, the cost for them previously was really high to get a conventional loan,
Right?
And so everybody sort of gravitated towards FHA, and I think this is the administration's way of trying to get some kind of backdoor home affordability program in place without calling it having to go through and pass a bill or do something like that to create some.
And I'm all for making home buying more affordable for people. Like,
I mean, look,
just not at the expense of paying more on my end.
Yeah.
No.
I mean, it's true, and unfortunately, the media is completely misrepresenting what is actually happening,
right.
And that is creating a lot of confusion out in the public about what this actually means. So let's clear up a couple of things right now. Okay,
let's do it.
The upfront fees, they're not points that you as the consumer are paying. It's typically built into the price of the mortgage. Unfortunately, margins right now for mortgage loans have shrunk, which has kind of created an environment where paying points is more common now or more acceptable.
Yep.
But this is not a direct, you're paying 75 basis points more or you're not getting 75 basis points higher in interest rate.
Is the 75 basis points like up to 75 basis points, or is it's 75 basis points?
It depends on, just think about these LLPAs as like a grid.
Right.
So
And I've seen the grids, yeah.
Yeah, you're going to see credit score and loan to value, or credit score
But
and loan to value, and then you go across the grid, and it's
Right.
this
like
this loan to value, this credit score, it's this is the cost for it, and then we turn around and we take a corresponding interest rate that has enough premium in that mortgage to cover that cost.
But is it a max of 75 basis points?
It's
Or is that just the number you use?
No, it's 75 basis points for that particular credit score at
Okay.
that particular
okay.
loan to value.
Okay.
Okay, but it changes as you go up and down in loan to value, and as you
Got
go
it.
up and down with credit score.
Okay.
But it's not not a direct correlation
Right.
to interest rates being higher or lower, and it's not a direct correlation to points paid by a consumer.
Got it.
Second thing is, a lower credit score borrower is not getting a better rate than a higher credit score borrower. Period. And it's
Right.
not happening. That is not.
And I don't
gonna
think
be the
that's
case.
how I looked at it. I looked at it from the perspective of it's more affordable to buy
Right.
now, not that someone who has a lower credit score is going to get a better rate than someone with a 700-800 credit score. I just looked at it like, well, now it's more affordable for that person with the 620 credit.
Oh no, there was literally people who
No,
think
no.
that they were getting a higher rate.
I
Like,
know
it's-
that, and those are
yeah.
the people that I would text back and be like, no.
Right.
Yeah.
Good
No.
clarification though, because again,
Yeah.
it's just so much fuel on the fire that people were just automatically diverting to that. Why am I have such a great, I have an 800 credit score or, a 750 credit score. Why am I going to be paying a higher rate?
Why am I being penalized
Right.
for it? And this and the other thing too is this is not some type of socialist, wild conspiracy theory. We're looking to penalize
Right.
high credit score borrowers.
Tax
Again,
leverage.
I think it's a really poor attempt at it, but I think that they're trying to create more affordability for lower credit score borrowers. And I think the reason for that, truthfully, is they're trying to shift those consumers away from FHA, which is a government-insured loan,
Yep.
into a conventional loan, which is a private sector,
Right.
historically a private sector loan.
Right.
And so by making these adjustments, hopefully they can close that gap and push a little bit more of the consumers in that direction.
Okay.
So to go backwards for a second, you talked about the 15 to 20% down with the 720 to 759. Percentage-wise, putting down for the lower credit score borrower, are there any, like how you gave the example of 15, 20%, was there an example for the lower credit score borrower, or you'll get into that?
Yeah, I'll get it.
Okay.
I'll get into
All
that and show that too.
Because you're saying get away from the FHA, but FHA, you
Yeah,
put
you'll
anything
see.
below 19, 20%,
once you go past, once you go past 10% down, then conventional and FHA start to come closer together,
Right.
From a cost standpoint and
Right.
from a payment standpoint, where you can make the argument, to go one way or the other based on the
Right.
borrower's credit profile.
Okay.
But when you start looking at when you're comparing apples to apples, and when I say apples to apples, I mean conventional loans, borrower putting 15 or 20% down, and they've got great credit, and you try to compare that to a borrower with a 630 credit score, and they're putting 5% down.
Right.
They're trying to bridge that gap or close that gap for those two consumers, so that it's not so overly punitive
Right.
to that lower credit score borrower. So
I'm just smiling because I'm looking at my notes and I see something that's coming up, and I just started in my head laughing at what you're probably about to say.
what, the government is not subsidizing?
No.
Oh, okay.
Then the one
So
after-
so the other piece of this is that the government is not subsidizing,
Right.
being irresponsible.
Right.
They're not trying to reward failure or discriminate against borrowers with higher credit score. That's not what this is. This is the fun one. This is the one with not paying the bills.
Yeah.
This is probably one of the funniest things that I've seen out there lately, which is literally had customers call and say, if I stop paying my bills and I get a lower credit score, can I get a better interest rate on my mortgage?
It's crazy.
Which is wild that people would even think that that's a good idea. So do not stop paying your bills because you're not getting a lower credit score.
Are you sure? Are you sure?
Are you sure that's good advice, wild. Ryan?
Huh? Yeah. Yes, I'm positive that that's great advice. So all that said, while these changes may not be as bad as some of the headlines, have suggested, which again is really just clickbait in my opinion.
Yep.
It does seem in some ways illogical to penalize borrowers that are responsible and pay their bills on time.
Yeah.
It's really just more of a thing of optics and just the way it was presented and the way it's being portrayed by the media and the way that the administration put out these changes and why we're doing them.
I think with how social media and politics have gone on the last 3+ years, that's unfortunately what happens right now. It's something happens in politically and automatically gets posted to Twitter and Instagram and TikTok, and you just have people who have no idea what they're talking about this.
Oh yeah.
You have Joe Blow in his basement. He's a gamer, and all he's talking about is credit scores. I'm like, you have no idea what you're talking about. Why are you doing this?
Oh yeah. I mean,
and then people listen to this guy.
It took off, and
it's crazy.
I wouldn't say that it went viral, but it really got a lot of traction.
No, I think for like quickly. 5 days it was viral.
A big topic. Big topic for a lot of people.
So now I know you wanted to touch on tie that back into in the article we had referenced to tie that back into default rates.
Oh yeah,
in the past that we had seen.
Yeah. So, this whole idea of them wanting to do this too. Really, when we price one of the ways we price mortgages is, you'll have these bean counters behind the scenes, actuaries who are actually looking at all the data and are saying, okay, we know a higher credit score borrower is going to pay their mortgage, so we're going to reward them for paying that because we want to get our money back. We don't want that loan to go into default and then ours have to spend thousands upon thousands of dollars to get the property or get our money back. So what was interesting was mortgage data talking about defaults for Fannie Mae and Freddie Mac mortgages back from 2006, 2007 for borrowers with low credit scores between 620 and 639 and who had only put down the minimum, or let's say 5%.
Right.
Back then, you saw default rates of anywhere from 39 to upwards of 50+% of those borrowers defaulted in some way on their mortgage.
Well,
with that 620 to 639 credit score.
Well, because back then mortgage brokers were.
Yeah. Yes. But it's interesting to highlight that statistic because we know that consumer is, historically speaking, doesn't pay their bills well.
Right.
And they're not fiscally responsible. They're not responsible with their money, and they will have a higher default rate on that product. Now, conversely, on a borrower who's putting down 15 or 20% and has a 740 credit score, back to the same time frame, you've got default rates of maybe 4, 5, 6%. Maybe it got up to maybe 8%. Throughout
when it got real bad in the crisis.
Yeah. So again, comparatively speaking, a borrower who's responsible and who has equity in the house is going to find a way to pay their mortgage and not default on that loan.
Right.
And they're more responsible. They have savings. They can support the loan that they're taking out. So, if you're an investor in buying mortgage-backed securities or buying mortgages as a business, why would you want to incentivize lending to lower credit score borrowers? You wouldn't.
Right.
It just wouldn't make sense for you to do that, nor would you want to do that. So now we can get off into the weeds a little bit on, the pricing of mortgages and margins and all the things that go into that. But just generally speaking, why would you as an investor want to buy a loan for somebody or
take
have
that risk for that type of reward.
Have a higher risk where that, hey, if I buy 10 mortgages, 4 or 5 of them may default and I may lose money on that. That doesn't really make a whole lot of sense. So one of the things that I did was, all right, what does this really mean?
Right.
What are we talking about interest rate wise? Because that's really what everybody cares about. This is all noise and all nonsense.
Yeah, because your everyday person is going to call you up and be like,
right.
What's your interest rate?
What does that look like? Yeah. What does that look like
for
me?
What does it mean for me? Right.
Right.
So what I did is I took a $400,000 mortgage, okay, which is fairly common nowadays, and just ran pricing just as a 750 credit score borrower, ran it as a 639 credit score borrower, and then also got FHA pricing as well, so we can kind of see the differences between the two, and did it with 5% down.
It's pricey.
Yeah, right. Yeah, 5% down and 15% down, even 20% down, so you can kind of get where the changes are.
Anything above 20%, 800s, getting affected too, or no?
Not really, because what they did is they actually sliced up the grid and added in more credit bands.
And I'm only asking because
when I say credit band, I say like 720 to 739, 740 to 759, 760 to 779.
Just shrinking those.
Yeah, you're now getting really granular.
The range isn't.
Yeah, previously it was 740 and above was A plus credit.
Right.
Well, now 740 is considered like A credit.
But this is good to understand, because if you're someone who does have a 760, 800 plus.
Yeah.
It will take your thought process about this to a different level and understand that, look, it's not what you're reading. It's not as bad as what you're reading.
Yeah. Again, the consumer, the borrower with a high credit score is not getting a lower interest rate or a worse interest rate.
Well, I think that was part of it, and the other part is almost like, why am I being taxed for this? Why are you charging me a fee for this?
And candidly, on some level, you could make that argument.
Absolutely.
And I can appreciate why somebody would think that. And when you really break it down, there is a slight cost to it. It's a slight cost increase. It's always going to be a slight cost increase. But again, the reality is that you as a high credit score borrower are never going to be subsidizing somebody with a lower credit score borrower.
Right.
We're in fact, all we've done is your rates have probably stayed the same. Their rates have come down a little bit. Is really what it amounts to.
I'm cool with that.
So all right, so 5% down.
Okay.
$400,000 loan amount. Okay, so it's a 425-ish purchase price. Okay. 750 credit score. Their rate today would be 6.5 with no points, or maybe a half a point at most cost. So a 639 credit score borrower, okay, in today's market would get 7.5. Okay. So it's about 100 basis points higher price wise. The caveat here, though, is the mortgage insurance. And I think this is where everybody's losing sight of what the cost is going to be for the consumer. Mortgage insurance. Now, this is a conventional loan, right? Conventional Fannie Mae, Freddie Mac loan. For a 750 credit score borrower, mortgage insurance would be about $125, $123, right? For a 639 credit score, mortgage insurance is $513 a month, conventional.
Wow.
Huge.
There's a big disparity there.
Yeah. That number hasn't really changed. So you're looking at in that loan scenario, you're looking at a mortgage payment that's about $3,300 versus about $2,650.
Okay.
So you're about $700 more a month for the same loan with a 640 credit score, 639 credit score.
Right.
All right. So now, all right, maybe low credit score borrower has a little bit of money now. Now we want to put down 15%. What does that do due to rates, because this is where the rubber's going to meet the road, and you're going to see the difference for the consumer. Okay, 750 credit score, $400,000 loan amount, which is about a 475 purchase price. Okay, so 15% down. Interest rate is 6.625.
Okay.
So we went up an eighth. That's it. Okay. 639 credit score, 7.625. Also went up about an eighth. So if we look at this and we say, okay, the consumer who's putting down 5% and their credit score is 639, they're getting 7.5%. Your consumer who's putting down 15 to 20% and has got good credit, 750 credit score, they're paying 6.625. Significantly better than what a lower credit score borrower would be.
Right.
But it's only up about an eighth in rate, which amounts to $33 a month payment wise.
Okay.
Change, right? So that increase of an eighth is $33 a month change.
Right.
Okay. The other side of that, or the other piece of that discussion, is the mortgage insurance. Okay. So for 750 credit score borrower, their mortgage insurance now drops to $73.
Okay.
Okay. And for the 640 credit score borrower, it drops down to $146.
Oh.
It's
Yeah.
It's a big
Big drop there.
number.
Big drop, right?
What was the first one? 500.
5 and change.
Yeah. 500 change.
Yeah.
So now you have a payment that goes, so you're at 20, so you're at 2650 ish, roughly, or no, sorry, 2630 roughly for the consumer, and for the 639 credit score borrower, you're looking at about right around $3,000.
Okay.
Give or take, with including the mortgage insurance. So, all said and done, higher credit score borrower still getting a very competitive rate, still significantly lower than a lower credit score borrower. It's only up about an eighth.
But being charged something.
They're being charged
a little
something.
more than what they were pre-May
Listen,
1st, right? Let's just
I
be
get it.
clear that they are being charged a little something
Right.
for all this to happen.
Now, where this gets fuzzy,
It's a good word.
right?
A little fuzzy.
Well, because now we start talking about things like, margins and the amount of money that mortgage companies are making and how this all plays out.
Right.
I would argue that it's possible. It would probably be possible for me to get to the 6.5 and offer that deal to the consumer, depending on the day and the rate. Where we are with, with some of the economic activity that's going on in the country right now. I would probably be able to get to that same 6.5% interest rate and offer that to the consumer if I needed to. So I think that eighth is probably got some a little elasticity to it, right?
Okay.
So I think it's just going to depend on the lender that you're talking to, and the current environment that you're in. All right, so now let's look at 20% down. Okay. Same scenario.
It's a good number.
20% down, zero mortgage insurance on any of these loans.
Right.
The rates actually stayed the same.
Okay.
So putting 20% down, the rate stayed the same as putting 15% down. The only difference would be the mortgage insurance.
No mortgage insurance.
Right. So 6.625 for a 750 borrower, 7.625 on a 639 credit score. Okay. This is where this gets interesting now.
Oh.
Let's talk about FHA.
Oh.
Because for a long time, the natural progression for a lower credit score borrower is to gravitate towards FHA.
Absolutely.
One of the main reasons for that is because there's a lot of mortgage insurance on an FHA loan. There's two types of mortgage insurance on an FHA loan, and this is probably a topic for a different day, but
yeah. Okay.
You have your upfront premium that goes directly to HUD to insure your loan.
That's the nice big
chunk that gets financed into the loan
that the buyer pays.
And you still have your monthly premium
right.
that gets paid to the investor to insure your loan. But because there's so much insurance on it, a lot of investors will pay up for that loan because there is very little downside.
Because it's government backed.
Because it's government insured,
Yeah, it's
and
government
it's got
insured,
a lot of insurance behind the scenes. And so the risk to an investor of that loan defaulting is, even though it may be high, the risk of recovery, or the ability to recover, is significantly greater because you have so much insurance behind the scenes.
Right.
So you typically get a much better interest rate by gravitating to FHA.
Right.
Okay. And for years, that's what you would do. You have a 639 credit score borrower, man, I'm going right to FHA. There's no, why would I quote him 7.625, you know, and try to give him that interest rate when I know I can get him a much better rate on FHA.
But real quick, financially speaking, does it make sense for that buyer to gravitate towards the conventional with the higher interest rate than pay a huge chunk of PMI up front, load it into their loan, and then pay a monthly?
Great question. Because what do we care about at the end of the day? We care about, what do I got to pay every month to repay this loan?
You would think that.
I would think
except for the buyer that only cares about what's the interest rate you can give me, because they only look at the number. They don't. You know.
Yeah, I mean, look, I mean, that's a broader topic.
Yeah.
But
it's
at the end of the day, the consumer cares about what they're paying on a monthly basis.
I know.
You know, the mechanics behind the scenes and the quality of the loan that they're getting. It's a conversation. I think that a lot of people just, their eyes roll back in their head and gloss over, and they're like, "What rate are you giving me?"
Right.
That's what eventually gets to. Yeah.
Right.
You know, so for a 639 credit score borrower, putting down 5%, to go back to the original scenario, their rate today would be 6.75
compared to
7.5.
But there's a but.
No, there's no but.
No but.
But it's a significantly lower interest rate. Number one.
Right.
Number two, the mortgage insurance, which was just recently reduced by FHA, is lower.
Okay.
So you're going to have a total mortgage payment of about $2,800 and change, give or take. Compared to $3,310. So you have about a $500 a month savings by doing an FHA loan, even though it is a worse loan when you look at all the different attributes of an FHA versus conventional.
Right.
You're still saving $500 a month.
Even paying the PMI.
Even paying the PMI. And even paying the PMI for life. You're saving $500 a month.
Right.
Now, eventually the $500 a month for the mortgage insurance on a conventional loan will come off, because it naturally amortizes off the loan.
Right.
So you basically have the same loan, even though your interest rate at 7.5 on conventional, and your FHA at 6.75 is essentially the same loan, payment wise, when you take out the mortgage insurance after a couple of years through amortization.
Right.
So, you know, it's a very interesting topic. You know, I think it's something that got so sideways so quick, and people immediately gravitated towards, oh my gosh, I'm paying more money and I'm going to have a higher interest rate and all this other stuff. But when you really dig into the numbers and you really look at it from a reality standpoint, no, you're not. You've got good credit score. You're getting a good rate.
I think people become illogical sometimes.
Yeah.
It's like, just sit back for a second and think. Put yourself in an investor's shoes, like you said earlier. Are you really going to, do that?
Correct.
To a higher investor.
Yeah, and that's why I think the optics of this. I think the administration did a really poor job of explaining what they're doing. Yeah. I think that it was just not the right way to do some type of home affordability or some type of subsidy.
Well, like you said, it was a way to circumvent having to put a bill out.
I just think that it was a bad idea. Yeah. I mean, I get the idea of trying to lower the cost, because if we go back to, or revert back to what the LLPAs were prior to this change, for that same consumer, remember that the cost now is 1.75 versus what it was previously was 3.75. So if I were offering the same rates, theoretically I'd have to charge the consumer 2 points to bridge that gap. Right. So I'm going to give a consumer 7.5, and now I'm charging them 2 points based under the old program.
Which is a lot.
which is a lot.
It's a lot of money.
On a $400,000 loan, that's $8,000. So I think that's the motivation there, was to try to help with the home affordability aspect of it.
And that's fine.
Lowering the cost
Yeah.
means that the borrower can get not necessarily a better rate.
No.
But their cost would be less, and they wouldn't have to come out of pocket so much,
It's
which make it easier for them to buy a home.
It's just more affordable.
Yeah.
That's honestly, listening to all of this, it's just about making it more affordable.
Yeah.
And again, like you said, optics wise and how they went about it, probably not the best way.
No,
you know, but
it could have been done better. It absolutely could have been done better.
But
I think
it is what it is.
Shame on the media for not trying to learn about what it is that we're trying to do and put out a realistic.
Why would they? Why would they?
Well, that's a topic for another conversation.
Topic for another day.
Both sides of the aisle. Why would they try to at least educate the people on why now it's more affordable for someone to buy a house than put these BS headlines out and scare people and get people on one side riled up, the other people on the other side misinformed, like, you know.
But with all things in closing, I mean, nothing's going to change from the fact that if you're a homeowner or you're a potential home buyer, you talk to your lender about what it means for you at the end of the day, cost wise. And that's nothing different that you were going to do, a month prior. You have to keep.
Yeah, you'd be surprised.
No, I'm not.
People just go online and go on like Quicken or something and just get. But
we have to keep telling them.
Yeah, don't do that. Call Ryan Merritt. No,
don't.
But whoever you call, you're a prospective home buyer. Whoever you call, Ryan, whatever other broker, whatever lender, it has to be a very transparent conversation about the cost.
Well, and here's the other thing too, and I not looking to denigrate any of my peers in the space, but who you're talking to matters. Who you work with matters, because a lot of this stuff in secondary, this is more of a secondary capital markets conversation. And when I say secondary capital markets conversation, it's the pricing of mortgages.
Right.
And not a lot of loan officers are going to fully understand some of these concepts and why they're doing what they're doing and how they're doing this. And that's where I think the challenge is too, because you may call up your loan officer, talk to them about it, and you may get some weird answers out of it. And
that doesn't really
either make sense or explain it
right.
in a way for you as a consumer to understand it and feel comfortable with what's going on. And so what do? You gravitate online, and now you see all this stuff online, and now you're like, what in the world is going on here? Why am I paying more for this? This is crazy. I'm not going to buy a house now. And so I think that you have to be careful with who you talk to too, especially a lot of the online lenders or a lot of the
Listen, you go on a Quicken or a Rocket, and you put everything in, and it spits back out your loan estimate, and you're like, 4%, and charging
like
they're
not bad. Those are not bad companies.
It's a good starting point.
You're not getting you're not getting the expertise behind the scenes to help you navigate.
Right. There's no understanding.
Single largest purchase.
You're not sitting there on the phone for 20 minutes or 30 minutes or 40 minutes.
Yeah.
With you
going through it.
Understanding the entire process and how it plays out from A to Z.
Yeah.
Cost wise,
logistically, of how we got to those numbers.
Right.
So.
Yeah.
So it's not a bad place to start. Go get a loan estimate and then go to you and say, hey, look, this is what I got. How does this?
Listen, I think the average consumer is smart enough to know when they got somebody on the phone who they can trust, or who they feel like has their interests at heart, or at least is listening to what their challenges are in the buying process, or what their concerns are in the buying process. As long as you have that, you've generally got a good egg, right? You've got a good guy or a good person that's trying to help you navigate this process. I just think that when you're dealing with a lot of these online lenders, they're the ones that are a little bit of a challenge, because you don't know. That guy may just be in the business. I had this happen. Quick side story. It was funny. Consumer calls me up, starts asking me all these questions, and we have a great conversation, but the consumer is pricing me against one of these online lenders. And I said, okay, well, send me the loan estimate. And so I sends me the loan estimate. I look it up, and I look at the lender, and I'm like, okay, I have the loan officer's NMLS number. Go online, look at you're right. Yeah, I told you this one. So this is funny, because I look him up. Nice young gentleman. He was working for like Pizza Hut 6 months ago, or like Domino's or something, like a pizza delivery. No,
don't knock Domino's. I mean, Pizza Hut, whatever. But...
Right.
What? Don't they have the cheesy,
Domino's or whatever. We're gonna Domino's or whatever the fancy Italian.
Stuffed crust pizza.
But it was because when you get licensed, you have to put in your work history.
Yeah.
And I don't know that I probably would have hidden that if I were him, but he put it on his
Good for him.
his employment record. And I said to the borrower, I said, look, you can do whatever you want. I would love to have your business, but just know that the person that you're, and I sent them a screenshot of it, and they're like, oh my gosh, I would never do that. Why would I do that? I said, okay, there you go. You know,
we appreciate the transparency.
Right. Yeah. You know, but consumers don't know that either. They don't know that they can go on and get that information and know who they're, and that's why, you know, we jokingly say who you work with matters, because it really does. You know, at the end of the day, you know, you get the right person with the right experience behind you, supporting you in this transaction. It'll make the transaction smoother. It'll help you answer all your questions, make you comfortable with it, and make it an enjoyable experience, because that's what you want at the end of the day. You don't want to have all this misinformation and all this, you know, fuzziness, if you will, right, about what you're doing. And so having that person behind you help you is huge. And something like this, which has gotten so much traction and so much misinformation, it's important to spend a couple minutes and really understand what it is. And when you really look at it at the end of the day, yeah, there's a slight cost for you as a higher credit score borrower, but the reality is that it's not enough for you to complain about unless you really want to complain. I mean, really, $33 a month.
I think at the end of the day, that the people who listen to this and get a very good understanding of it and still complain.
They probably want to complain.
They're just complaining.
Maybe we'll just complain a little bit less.
Yeah,
right.
Maybe they'll hopefully we're able to let those people, you know, and help their families. Yeah. Let them complain a little less.
The bigger challenge right now is understanding where rates are and how rates are all over the map. And
that's a podcast.
Yeah, that's a different conversation, because you could talk to one lender today and it could be 5.5, and you could talk to another lender tomorrow and it's 7.5.
Yeah. Well, I mean, just again, good clarity on it, and obviously moving forward, hopefully everyone has a little bit, you know, less uneasiness, and don't just jump right to the headlines, and you know, try to get a little bit of understanding behind it.
Talk to a professional.
I was gonna say, or if you do look at the headlines, reach out to someone.
Yeah.
Talk to an experienced professional.
Get help.
Yeah, they'll generally guide you through all this, and there's a lot of them out there. Just, you know, the online guys are the ones where you got to be a little bit careful. So.
But great job today.
Thank you.
Thanks, Ryan.
Really good.
Thank you.
It was really good.
It's an exciting topic.
It's been a pleasure.
Yeah,
it's been a pleasure.
Let's do it again.
Let's do it again sometime.
All right.
That's right.
Till next time.
That's right.